Hello and welcome. Have you ever wondered how real estate investors make sure they have enough cash on hand to pay their bills, especially when money can be tied up in properties? It's a bit like managing your own household budget, but often on a much larger scale. If you don't have cash ready when you need it, things can get tricky fast, right? Well, that's exactly what we're going to explore in this course, Real Estate Liquidity Metrics. By the end of this module, you'll be able to explain what liquidity means in the world of real estate. Understand why it's super important for both big real estate companies and individual investors to keep an eye on their liquidity. Get a sneak peek at the main tools or metrics we'll be using to measure this. So let's dive in. What exactly are these liquidity metrics? Think of them as essential tools, like a doctor's stethoscope, but for checking the short-term financial health of anyone involved in real estate. This could be a large company juggling many projects, or it could be an individual investor who has personal expenses and maybe a mortgage to think about. These metrics help us see if a person or a company can easily pay their immediate bills. We're talking about things like paying suppliers for construction work, covering salaries or your own living costs, and making payments on short-term loans. Imagine you own an Airbnb apartment in a bustling city like Rome. You need to pay for cleaning services, utilities, and maybe some minor repairs. Liquidity is about having the cash ready for those things. Why is this so important? Well, if you understand these liquidity metrics, you're in a much better position to judge the level of risk involved in an investment. It also helps you see if an investment can actually pay back what's owed and how financially stable it is overall. This isn't just useful for you as an investor. Lenders and property managers also use this information to make smart decisions. In this course, we're going to look at some of the most common and important liquidity metrics used in the real estate world. These include the current ratio, the quick ratio, cash flow analysis, and the payback period. Don't worry if these terms sound a bit technical right now. We'll break each one down with simple explanations and real-world examples. Ready to get started? Great. Let's move on to our first key metric. The current ratio, a first look at liquidity. The current ratio is a financial metric that tells us how well a company can handle its short-term financial responsibilities, specifically those bills that are due within 1 year. How do we figure this out? It's pretty straightforward. We calculate it by dividing the company's current assets by its current liabilities. Think of it this way. The current ratio shows you how many dollars in current assets a company has for every $1 it owes in current liabilities. Let's break down those terms. Current assets. These are things the company owns that it expects to turn into cash within a year. This includes actual cash in the bank, money owed to the company by customers, called accounts receivable, and any inventory it holds, like building materials for a construction project or completed apartments ready for sale. Current liabilities. These are debts that the company needs to pay off within a year. This could be money owed to suppliers, accounts payable, or short-term loans. The formula is simple. Current ratio equals current assets divided by current liabilities. So you've done the calculation. What does the result tell you? If the ratio is above 1, that's generally a good sign. It suggests the company has more current assets than current liabilities, meaning it's in a good position to pay its short-term debts. The higher the ratio, the more liquid the company is, and the better its ability to meet those obligations. If the ratio is below 1, it might signal potential trouble. This means the company has more short-term debts than it has current assets to cover them, which could make it difficult to pay its bills on time. Why is the current ratio so important? Liquidity assessment. A higher current ratio means better liquidity. This indicates a stronger ability to meet those short-term debts without stress. Risk assessment, simply put, a lower ratio means higher risk. It flags potential difficulties in paying off those upcoming financial obligations. Investment decision making. If you're looking to invest, the current ratio helps you assess the risk and take a decision. Now, let's bring this into the real estate world. Why is this ratio particularly vital here? Imagine a company is building a new block of apartments. Cash flow is absolutely critical in construction projects. A high current ratio gives assurance that the company can cover its ongoing expenses. These expenses include payments to contractors, suppliers for materials, and all the other costs involved in building. This is super important, especially when the economy is a bit shaky and getting credit from banks might be tougher. Let's consider an example. Think about a real estate development company working on a new housing project. Let's look at their finances. Regarding cash in bank, they have $2 million. Regarding accounts receivable, this is money from apartments they've sold but haven't received full payment for yet. They are owed $1,500,000. Regarding construction materials inventory, this is valued at $1 million. Regarding accounts payable, money they owe to their contractors and suppliers, this is $1 million. Regarding short-term loans, they owe $500,000. Regarding expected payments to contractors in the next month, this amounts to $750,000. Now let's do the calculation. First, we add up all their current assets, $2 million, cash plus $1,500,000, accounts receivable plus $1 million inventory equals a total of $4,500,000 in current assets. Next, we add up their current liabilities, $1 million accounts payable plus $500,000 short-term loans plus $750,000 expected payments equals a total of $2,250,000 in current liabilities. Now, for the current ratio calculation, current ratio equals $4,500,000 divided by $2,250,000, which equals 2. What does this mean? It means the company has $2 in current assets for every $1 of current liabilities. This is a healthy sign. It indicates good liquidity and shows the company is well positioned to meet its short-term financial obligations. If you were considering investing in this company, this ratio would give you some confidence in their short-term financial stability. Now that we've got a good grasp of the current ratio, let's move on to another useful metric that gives us an even stricter look at a company's liquidity. The quick ratio, a stricter liquidity test. We've talked about the current ratio, which gives us a general idea of a company's ability to pay its short-term bills. But what if we wanted an even more conservative or stricter measure? That's where the quick ratio comes in. The quick ratio is a financial metric that looks at a company's ability to meet its short-term obligations using only its most liquid assets. The key difference here is that it doesn't include inventory in those assets. So, in simple terms, the quick ratio shows us how many easily cashable assets a company has for every dollar of its current liabilities, leaving out the inventory. The formula for the quick ratio is quick ratio equals current assets minus inventory divided by current liabilities. Let's clarify the components again. Current assets. As before, these are assets that can be turned into cash within a year. Inventory. This is the value of the goods the company has on hand to sell, like completed houses for a developer or raw materials. Current liabilities. These are the debts that need to be paid within a year. What does the quick ratio tell us? Generally, a quick ratio of 1 or more is considered good. It suggests the company can meet its immediate obligations without having to quickly sell off its inventory. Just like with the current ratio, A higher quick ratio is usually better, indicating stronger immediate liquidity. It's also important to remember that what's considered a good quick ratio can vary a lot depending on the industry and the type of business. So, it's always a good idea to compare a company's quick ratio with others in the same field. For example, a supermarket will naturally have a lot of inventory, so its quick ratio might look different from a software company's. Why do we exclude inventory? This is a really important question. Why single out inventory and remove it from the calculation? Inventory is usually the least liquid of the current assets. Think about it. How quickly can a real estate developer sell a large building or a plot of land if they suddenly need cash? It can take time to sell inventory. And sometimes, if a company is desperate for cash, it might have to sell its inventory at a discounted price, meaning it gets less money than it hoped for. Therefore, the quick ratio excludes inventory to give a more cautious and realistic measure of a company's ability to pay its immediate bills. The importance of the quick ratio. Why should we pay attention to this stricter measure? Evaluation of immediate liquidity. A higher quick ratio means the company has a better ability to cover its short term debts right now without waiting to sell anything that might take time. Conservative risk assessment. Because it ignores inventory, which can be tricky to convert to cash quickly, the quick ratio offers a more conservative view of risk compared to the current ratio. Investment decision making. Investors and lenders often use the quick ratio to get a clearer picture of the risk involved before investing or lending money to a company. The quick ratio in the real estate world. Let's consider how this applies specifically to real estate, particularly income-generating properties. Imagine a company that owns and rents out office buildings like a sleek office tower in a city center. For this kind of business, a steady cash flow from rent is absolutely vital. A high quick ratio helps ensure that the company can still meet its obligations, like mortgage payments or property taxes, even if there are unexpected delays in receiving rent payments from tenants. By not counting on potentially slow-moving inventory, like a building they might be trying to sell, this ratio provides a more realistic picture of the company's financial footing. It shows if the company can handle surprises, such as a major tenant suddenly going out of business, or the need for urgent, expensive repairs to a property. Let's look at an example. Consider a company called City Assets, which invests in office buildings and shopping centers. Here's their financial snapshot. Current assets, cash in bank, $3 million. Accounts receivable, money owed by tenants, $1 million. Short-term deposits, $500,000. Inventory, $200,000. Total current assets, $4,700,000. Let's move on to current liabilities. Accounts payable, money owed to maintenance contractors, $800,000. Short-term loans, $1,200,000. Expected payments in the next month, $500,000. Total current liabilities, $2,500,000. Calculating the quick ratio. Quick ratio equals total current assets minus inventory divided by total current liabilities. So that's $4,700,000 minus $200,000 divided by $2,500,000, which equals 1.8. Analysis. The quick ratio for city assets is 1.8. This means the company has $1.80 in liquid assets, excluding inventory, for every $1 of current liabilities. This is a very good sign. It suggests City Assets is in a strong liquidity position and can comfortably meet its immediate financial obligations. By understanding both the current ratio and the quick ratio, we get a more rounded view of a company's short-term financial health. Next up, we'll explore another crucial concept, cash flow. Understanding cash flow, the lifeblood of real estate. What exactly is cash flow? Imagine a river. Water flows in and water flows out. Cash flow in a business is very similar. It describes the movement of cash both into and out of a company, a specific project, or even a single property over a certain period. Essentially, cash flow tells us the total amount of cash received. These are the receipts or inflows, and the total amount of cash paid out, the disbursements or outflows during that time. The cash flow measures the actual movement of cash, not just the profit shown on paper, which is often called accounting profit. It reveals how much cash is truly available for the company to meet its ongoing bills, invest in new opportunities, and even pay dividends to its shareholders. It's a critical measure of liquidity because it directly shows the company's ability to generate enough cash to cover its financial responsibilities. The importance of cash flow. Positive cash flow is good news. It means the company has enough cash coming in to cover what's going out and then some. Negative cash flow, on the other hand, is a red flag. It means the company is spending more cash than it's bringing in, which isn't sustainable in the long run. Managing cash flow effectively is absolutely vital for any company to survive and grow. It's truly a critical indicator of a company's overall financial health. Cash flow in real estate companies, repayment ability. Positive cash flow allows a real estate company to comfortably meet its current obligations, like mortgage payments and property taxes. Project financing. If a company wants to build a new shopping center or renovate an apartment complex, positive cash flow provides the funds to do so. Asset valuation. When trying to figure out how much a property is worth, the expected future cash flow it can generate is a key factor. Risk management. Analyzing cash flow helps a company spot potential financial risks before they become big problems. The cash flow statement. The cash flow statement is a financial report that clearly shows all the cash movements within a company over a specific period, like a quarter or a year. This statement provides really important information for investors, lenders, and anyone else with a stake in the company. It's important to know that cash flow is different from net income or profit. Net income is calculated using accounting rules and might include non-cash items, while cash flow tracks only the actual cold, hard cash moving in and out. How is cash flow calculated? There are two main ways to calculate cash flow, the direct method and the indirect method. Direct method. This method involves tracking all the actual cash coming in, receipts, and all the cash going out, payments. It gives a very accurate picture of cash movements, but requires careful tracking of every single transaction, which can be a lot of work. Typically, this method breaks down cash flow into three main activities: operating, investing, and financing. We'll talk more about these in a moment. Indirect method. This method starts with the company's net profit from the income statement and then makes adjustments for things that affected profit but didn't involve actual cash movements like depreciation and changes in working capital, like changes in money owed by customers or money the company owes to suppliers. This method is generally easier to use, especially when you're looking at published financial statements, but it might not be quite as precise in showing the actual cash trail as the direct method. Key steps in calculating cash flow. Here's a simple overview of the process presented step by step. Step 1. Define the period. First, you decide on the time frame you want to look at. For example, are you interested in the cash flow for a month, a quarter, or a whole year? Step 2. Data collection. Next, you gather all the relevant financial data. This includes all revenues, expenses, investments made, and any financing activities. Step 3. Categorize cash movements. Then you divide these cash movements into logical categories, most commonly operating, investing, or financing activities. Step 4. Calculate net cash flow. After that, you calculate the difference between all the cash that came in and all the cash that went out for each category, and then overall. Step 5. Analyze the results. Finally, you analyze these results to understand the company's cash flow situation and pinpoint any areas that might need improvement or further investigation. In a real estate company, cash flow is typically broken down into three main types of activities. Operating activities. This is about the cash generated from the main day-to-day business of the company. Inflows, receipts. This is primarily rental income from properties the company owns and rents out. If the company's main business is buying and selling properties, like a house flipper, then income from selling those properties would also be an operating activity. Outflows, payments. These are operating expenses such as costs for property maintenance, property management fees, insurance, and property taxes. If the company buys properties as its main business, the purchase cost would be here too. Investing activities. This relates to cash spent on or received from the sale of long-term assets, things the company plans to keep for a while to help it make money. Inflows, receipts. This includes proceeds from the sale of assets, like when a company sells a commercial building or a piece of land it owns. Outflows, payments. This includes purchase of assets, like buying new properties to add to its portfolio or investments in projects, which are payments for developing new real estate projects. Financing activities. This involves how the company raises money and pays back its investors and lenders. Inflows, receipts. This could be loan proceeds, cash received from taking out loans from banks or other financial institutions, or equity financing, cash received from selling shares in the company or bringing in new partners. Outflows, payments. This includes loan repayments, paying back the principal and interest on loans. The net cash flow is simply the sum of the cash flows from all three types of activities. The formula is net cash flow equals cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities. Let's walk through an example of a real estate company's cash flow. Imagine we're looking at the cash flow statement for a real estate company for the year 2025. The amounts are in millions of dollars. Here's how the data might look, broken down by activity. Operating activities, receipts from rental income, $50 million. Receipts from sale of apartments, $30 million. Payments for maintenance and property management, $10 million. Payments for employee salaries, $8 million. Payments for taxes, $5 million. Net cash flow from operating activities, 50 plus 30 minus 10 minus 8 minus 5 equals $57 million. This is positive, which is great. It means their core business is generating cash. Investing activities, proceeds from sale of land, $15 million. Payments for purchase of land, $20 million. Payments for development of new project, $25 million. Net cash flow from investing activities, 15 minus 20 minus 25 equals minus $30 million. This is negative, which is common for growing companies as they are investing in future assets. They spent more on buying land and developing projects than they made from selling assets. Financing activities, proceeds from bank loan, $20 million. Payments for loan repayments, $10 million. Payments for dividends, $5 million. Net cash flow from financing activities, 20 minus 10 minus 5 equals $5 million. They took on new debt, but also paid back some old debt and paid dividends. So, the total net cash flow is the sum of these three. Net cash flow equals $57 million from operating, minus $30 million from investing, plus $5 million from financing, which equals $32 million. What does this tell us? The company generated healthy positive cash flow from its main operations, renting and selling apartments. It invested quite a bit in buying land and developing new projects, leading to a negative cash flow from investing activities. This isn't necessarily bad if these investments are expected to generate good returns in the future. The company also took on some new loans while paying off others and rewarding shareholders with dividends. Net change in cash. Overall, the company's cash balance increased by $32 million during the year. This means they had more cash at the end of the year than at the beginning. Understanding cash flow gives us a dynamic view of how money moves through a real estate business. Next, we'll look at a specific type of cash flow that many investors find particularly insightful: free cash flow. Free cash flow, FCF. We've talked about cash flow from operations, investing, and financing. Now, let's focus on a metric that many savvy investors really like: free cash flow, or FCF. So, what is it? Free cash flow tells us how much cash a company has left over after it has paid for its day-to-day operating expenses and its long-term investments, often called capital expenditures. FCF doesn't include cash flows from financing activities like borrowing money or repaying debt. Essentially, free cash flow is the cash that the company generates from its core business operations that truly remains available for a variety of uses. What can a company do with this free cash? Pay dividends to shareholders, buy back its own shares, share repurchases, reduce debt, or make new investments or strategic acquisitions. Why do investors often get excited about companies with high free cash flow? Many investors use FCF as a key tool to figure out a company's true value and to help them make investment decisions. A company with high and consistent free cash flow is often seen as healthy and strong. It signals that the company has financial flexibility and is better equipped to handle economic challenges or seize new opportunities. The most common way to calculate free cash flow is FCF equals cash flow from operating activities minus capital expenditures. FCF versus net income. What's the difference and why does it matter? You might remember we said that cash flow is different from net income. Let's understand why. Net income. This is an accounting metric. It represents a company's profitability on paper, but it doesn't always reflect the actual cash movements because of things like depreciation, an expense that reduces profit but doesn't involve cash going out the door. So, net income can sometimes give a less accurate picture of the actual cash a company has available than free cash flow does. Free cash flow, this metric focuses on the real cash available to the company after it has covered its operating costs and essential capital spending. Because of this, FCF often provides a more accurate picture of a company's true ability to generate cash, pay its debts, and invest in future growth. Let's see an example of calculating FCF. A real estate company has the following data: cash flow from operating activities, $20 million. CapEx for the year, $5 million. FCF equals cash flow from operating activities minus capital expenditures. So FCF equals $20 million minus $5 million. FCF equals $15 million. This means that after covering all its regular operating costs and the necessary investments in its properties, the real estate company has $15 million in free cash flow. This $15 million is available for things like paying down debt, distributing to shareholders, or reinvesting in new growth opportunities. A positive FCF like this is generally a good sign of financial health. Understanding free cash flow gives investors a clearer view of a company's ability to generate surplus cash, which is a key indicator of its long-term potential. Next, we'll look at a metric that helps us understand how quickly an investment can pay for itself, the payback period. The payback period. How fast do you get your money back? Imagine you've opened your dream coffee shop, investing significantly in the setup and initial stock. As customers enjoy their lattes, you're likely wondering, how long until the shop's profits fully repay my startup costs? Figuring out this payback time is a common and crucial question for any investment. The payback period is a financial metric that does exactly that. It tells you how many periods, usually years, it will take for the cash generated by an investment to repay the original cost of that investment. Simply put, it's the time it takes to recover your initial investment. This metric is popular because it's straightforward and helps with a few key things. Risk assessment. Generally, a shorter payback period is seen as indicating lower risk. Why? Because your initial capital is tied up for less time, and you recoup your investment faster, reducing the uncertainty that comes with long-term forecasts. Liquidity assessment. A shorter payback period also suggests higher liquidity for that specific investment. The faster an investment pays back its cost, the faster that capital is freed up and turned back into cash, which can then be used for other things. Investment decision making. The payback period can be a simple tool to compare different investment opportunities. If you're choosing between several projects, you might lean towards the one with the shortest payback period, all other things being equal. Important limitations to keep in mind. While the payback period is easy to understand and calculate, it's not perfect. It has some significant limitations. It does not take into account the time value of money. This is a crucial concept in finance. It means that $1 today is worth more than $1 you receive in the future, because today's dollar can be invested and earn a return. The payback period treats all cash flows the same, regardless of when they are received. It does not consider cash flows received after the payback period. An investment might have a quick payback but then generate very little cash afterward. Another might take longer to pay back but then produce substantial cash flows for many years beyond its payback point. The payback period won't tell you this. So, while it's a simple and easy to calculate metric, it might not always give you a complete picture of an investment's overall profitability or long-term value. It's often best used alongside other financial metrics. Calculating the payback period. The way we calculate the payback period depends on whether the annual cash flows from the investment are expected to be the same each year, equal cash flows, or different each year, unequal cash flows. 1. Calculating for equal cash flows. When an investment is expected to generate the same amount of cash flow each year, the formula is very simple. Payback period equals initial investment divided by annual cash flow. Example, with equal cash flows, let's say you're thinking about investing in a project that requires an initial outlay of $100,000. This project is expected to generate an annual cash flow of $25,000 for several years. The calculation would be payback period equals $100,000 divided by $25,000 per year, which equals 4 years. So the payback period for this project is 4 years. It will take 4 years for the project's cash earnings to cover the initial cost. 2. Calculating for unequal cash flows. What if the project generates different amounts of cash each year? This is very common with real estate investments, where rental income might change or operating expenses could vary. In this case, we need to sum the annual cash flows year by year until the cumulative total sum equals the initial investment. Example with unequal cash flows. Suppose you are considering investing in a different project. This one requires an initial investment of $150,000. The project is expected to generate the following annual cash flows. Year 1, $50,000. Year 2, $40,000. Year 3, $30,000. Year 4, $40,000. Let's calculate the payback period by looking at the cumulative cash flow. End of year 1. Cumulative cash flow is $50,000. Still need $100,000 more to cover the initial $150,000. End of year 2. Cumulative cash flow is $50,000 from year 1 plus $40,000 from year 2 equals $90,000. Still need $60,000 more. End of year 3. Cumulative cash flow is $90,000 from end of year 2 plus $30,000 from year 3 equals $120,000. Still need $30,000 more. End of year 4. The cash flow in year 4 is $40,000. We only needed $30,000 more dollars at the start of year 4 to reach our initial investment of $150,000. Since year 4's cash flow is more than what we need, we know the payback happens sometime during year 4. To be more precise, we can figure out the fraction of the 4th year needed. Amount remaining to be recovered at the start of year 4. $150,000 initial investment minus $120,000 cumulative cash by end of year 3 equals $30,000. Cash flow generated during year 4 is $40,000. Fraction of the 4th year needed, $30,000 divided by $40,000 equals 0.75. Therefore, the payback period is 3 years plus 0.75 of a year, or 3.75 years. Understanding the payback period can give you a quick sense of how long your money will be tied up in an investment. While it has its limitations, it's a useful, simple metric to have in your toolkit. This covers the main liquidity metrics we set out to explore. By understanding the current ratio, quick ratio, cash flow analysis, free cash flow, and the payback period, you're now much better equipped to evaluate the short-term financial health and risks associated with real estate investments. Remember, no single metric tells the whole story, so it's often wise to look at them together.